Welcome. In this video, Zbcn coin can rise 230% if it returns from here. So why? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand.
The fact that the price is currently sitting right on top of support, and that this level was previously a resistance, is a very strong reversal signal in technical analysis. Because when a level flips from resistance into support, it reflects how market psychology has evolved. Where the price once faced sellers and turned down, it now finds buyers stepping in, signaling a powerful shift in the market. This transformation is highly valuable in the eyes of investors because a barrier that once couldn't be broken now acts as a foundation that pushes the price higher, showing that the trend is strengthening. Especially when the price manages to hold this level, it suggests the market is preparing to target higher levels. Psychologically, this flip represents a rebuilding of confidence. A level once dominated by sellers is now held by buyers, and that can completely change the overall perception of the market. For this reason, holding above support can serve as an early indication of a new bullish wave. These levels are often backed by very high trading volume, because when traders and investors realize that a former resistance has now turned into support, they tend to make large purchases. This creates strong upward momentum from that level. In other words, these resistance-turned support zones reinforce investor confidence. Each time the price successfully holds above it, market participants buy with even more conviction. This can act like a magnet pulling the price higher. The key point here is that with every retest, the price tends to bounce with stronger momentum, because this area is now seen as a must-hold level, and players step in aggressively to defend it. Holding above support also confirms the trend from a technical standpoint. A resistance level that breaks upward and then starts acting as support is one of the strongest signs that a trend is healthy. In this case, the uptrend is not seen as just a short-term move, but as part of a longer-lasting structure. Seeing the market build a new base at this point is crucial for setting larger targets, because for a trend to continue, it's not enough for price to simply move up. Broken levels must hold as support. The current picture shows exactly that. From an investor psychology perspective, price stability at this support level is clear proof of how strong buyers are in the market. As long as the price does not fall below it, the dominant market sentiment is usually optimism. This optimism attracts new buyers and also encourages existing holders to maintain their positions. This creates strong buying pressure. Especially when a resistance flips into support, investor confidence increases, which can lead to longer-term positions being opened. That helps the price rise more steadily. Looking at it more deeply, the price breaking above a level that was once resistance and now holding there signals a major change in the supply-demand balance. Where sellers once outweighed buyers, now buying demand has become stronger. This shift in supply-demand dynamics lays the foundation for a strong rally, because when price breaks above a key resistance and turns it into support, it shows a new balance of power in the market. As a result, the price may climb even further. Protecting support also allows technical patterns to play out properly. For example, when price holds above such a level, higher lows begin to form. Higher lows are one of the strongest confirmations of trend strength. As long as each new low is above the previous one, participants begin aiming for higher highs. In this case, protecting the resistance-turned support level forms the foundation for not just a short-term move, but also a long-term uptrend. That's why price holding above support right now is so critical. These kinds of flips also offer very strategic opportunities for investors. A level that once acted as strong resistance, when broken and turned into support, is often considered one of the safest buying zones, because investors don't expect the price to fall back below it. Instead, they believe the move will continue upward. For this reason, buying from these zones tends to be both lower risk and higher reward, showing one of the biggest advantages of technical analysis. Looking at the current situation, holding above support is essentially a show of strength. Sellers' attempts to drag the price down fail here, and buyers stay in control. If this control is maintained, the price could gain much stronger momentum going forward. Especially as long as resistance-turned support levels hold, the market's upside potential grows even more, because these levels matter greatly both technically and psychologically. In conclusion, the fact that the price is right on top of support and that this level was previously a resistance is one of the strongest signals of a healthy uptrend. This not only confirms trend continuation, but also creates safer buying opportunities for investors. Buyers protecting this level sets the stage for higher targets ahead. Therefore, this can be viewed as a positive development. If the price continues to hold above this support, the uptrend could strengthen even further, and the market could see new highs. That's why protecting support is critical not only for the short term, but also for long-term bullish momentum. But we cannot rely on support alone to make decisions, so let's also look at other metrics. Stay tuned.
In the vortex indicator, when the blue line moves above, it is one of the most critical signals that a strong upward trend has begun in the market. This situation generally indicates that buyers have taken control and that the price has gained upward momentum. The vortex indicator is a specialized technical analysis tool developed to measure the direction of the market trend and the strength of that trend. It contains two different lines. One represents positive directional movement, and the other represents negative directional movement. The intersections of these lines, or which one is positioned above the other, give us clues about the potential future direction of the price. The blue line being on top, meaning the positive line is positioned above the negative line, shows that buyers are dominant and that an upward trend has begun in the market. For many investors, this signal is reassuring because it strongly confirms that the upward price movement may continue. The blue line moving upward actually indicates that momentum in the market has completely shifted in favor of buyers. For investors, this means the market has escaped downward pressure and that a more stable upward movement has begun. Such crossovers in the vortex indicator are often precursors of trend reversals. In other words, if the price was previously moving sideways or in a downtrend, the upward crossover of the blue line emphasizes that the decline has ended and that a new upward wave has begun. This situation does not only reflect a short-term move, but also suggests that the medium and long-term trend may strengthen. Because unlike ordinary indicators that follow small fluctuations, the vortex indicator helps to see the bigger picture by tracking the overall market direction. One reason investors evaluate this signal positively is its harmony with price action. When the blue line rises, the price usually breaks through significant resistance levels or bounces off support to start a new upward move. At this point, breaking regions that the price has repeatedly tested but failed to surpass in the past further strengthens the trend. This is because psychological barriers in the market are broken and new buyers step in. In such cases, not only technical traders, but also investors following fundamental developments begin to trust the price direction and participate more. As a result, with an increase in volume, the upward trend rests on a stronger foundation. The blue line moving upward in the vortex indicator can be seen not only as the start of a trend, but also as a safe buying opportunity. Especially if the red line, meaning the negative line, was previously on top while the price kept moving downward, the upward crossover of the blue line signals to investors that the market has now changed direction. This means uncertainties in the market have ended, those caught in the downtrend have exited, and buyers have completely taken control. In such moments, strong momentum is usually observed, and the price often climbs upward quickly within a short period.
The inverse head and shoulders pattern is considered one of the most trusted and most widely used reversal formations in the world of technical analysis. This is because it strongly signals that prices may recover from bottom levels and enter a new uptrend. Especially in the eyes of investors and traders, the appearance of this pattern symbolizes that confidence is returning to the market, buyers are gradually taking control, and the probability of prices gaining upward momentum for a while has increased. In the situation you mentioned, the possibility of the price completing the last shoulder and then rising by the depth of the head clearly demonstrates the classical rule of this formation in technical analysis. In technical literature, when an inverse head and shoulders pattern is completed and the neckline breaks upward, the target measurement is the distance between the bottom of the head and the neckline, and this distance is projected upward to find the price target. If in your scenario this measurement, meaning the depth of the head, points to a 230% increase, it shows just how powerful this structure can be. To understand the psychological aspect of the inverse head and shoulders pattern, we first need to visualize how the price moves. Initially, while the market is moving in a downtrend, the price makes a bottom and then recovers briefly to form a small peak. This formation is called the left shoulder. Then selling pressure increases again and the price drops even lower than the previous bottom, creating a deeper dip. This is the head. At this stage, there is usually a strong sense of panic in the market as the price is broken below the previously established support level. But the interesting part comes afterward. From this deepest low, the price starts to recover again and climbs back toward the neckline. After that, another wave of selling appears, but this time the selling pressure has weakened. The price makes another dip, but this dip stays higher than the head, forming a shallower low. This is the right shoulder, and it represents a critical psychological turning point in the eyes of investors. The formation of the right shoulder signals that sellers are losing strength and buyers are becoming more active in the market. After the right shoulder is formed, all eyes turn to the neckline. If the price breaks above this neckline with strong volume, the pattern is officially confirmed. A confirmed inverse head and shoulders not only signals to investors that the trend is changed, but also provides a specific price target. This target equals the distance between the head's lowest point and the neckline, and this distance is projected upward to find the price target. If in your scenario this measurement, meaning the depth of the head, points to a 230% increase, it shows just how powerful this structure can be. To understand the psychological aspect of the inverse head and shoulders pattern, we first need to visualize how the price moves. Initially, while the market is moving in a downtrend, the price makes a bottom and then recovers briefly to form a small peak. This formation is called the left shoulder. Then selling pressure increases again and the price drops even lower than the previous bottom, creating a deeper dip. This is the head. At this stage, there is usually a strong sense of panic in the market, as the price is broken below the previously established support level. But the interesting part comes afterward. From this deepest low, the price starts to recover again and climbs back toward the neckline. After that, another wave of selling appears, but this time the selling pressure has weakened. The price makes another dip, but this dip stays higher than the head, forming a shallower low. This is the right shoulder, and it represents a critical psychological turning point in the eyes of investors. The formation of the right shoulder signals that sellers are losing strength and buyers are becoming more active in the market. After the right shoulder is formed, all eyes turn to the neckline. If the price breaks above this neckline with strong volume, the pattern is officially confirmed. A confirmed inverse head and shoulders not only signals to investors that the trend is changed, but also provides a specific price target. This target equals the distance between the head's lowest point and the neckline, and this distance is projected upward to find the price target. If in your scenario this measurement, meaning the depth of the head, points to a 230% increase, it shows just how powerful this structure can be. The psychological aspect of the inverse head and shoulders pattern is very important. The inverse head and shoulders essentially tells a story that the downtrend is nearing exhaustion and buyers are making a strong comeback. At the stage when the head forms, sellers use their final strength to push the price deeply downward, but when the price recovers from that bottom and the right shoulder forms at a higher low, it becomes clear that sellers are no longer as powerful as they once were. In the eyes of investors, this is like a signal of the buyer's coming victory. The upward break of the neckline confirms this victory. Now let's think more carefully about the 230% upside potential. This percentage points to a very strong increase and offers investors incredible potential. Especially in the cryptocurrency markets, such sharp rises have happened many times in the past, often triggered by the confirmation of strong patterns like this one. For example, if a coin's price rises from $1 to $3.30, that's a 230% increase, which gives investors very high returns in a short period. That's why traders who follow technical analysis pay great attention to such patterns, and when they see the reliable structure of an inverse head and shoulders, they strengthen their buying strategies. In this scenario, the possibility of the right shoulder being completed also creates anticipation.
Before the right shoulder is fully formed, the market is still somewhat uncertain. Some investors are unsure whether the price will truly recover, but once the right shoulder clearly forms, this uncertainty turns into confidence. Buyers enter the market more boldly, selling pressure decreases, and the likelihood of the price moving toward the neckline increases. When the neckline breaks, a significant increase in trading volume is usually observed. This surge in volume shows just how strong the buying appetite is and that a wave of confidence has spread across the market. Another point to consider is that along with the formation's target, psychological resistance levels must also be taken into account, because sometimes, even if the technical target suggests a 230% increase, the price may pause temporarily as investors take profits at certain levels. However, since the overall trend is upward, such corrections are generally considered healthy and do not prevent the continuation of the rally. On the contrary, these corrections allow the uptrend to proceed more sustainably. In conclusion, as you said, when such an inverse head and shoulders forms and the right shoulder completes, a rise equal to the depth of the head is the classical rule of technical analysis. In this case, a potential 230% increase paints a very strong and positive scenario for the market. This creates not only a technical basis, but also a psychological driving force that pushes the market upward. Because when investors see such a pattern, they expect the same outcome, calculate the same targets, and this collective behavior further accelerates the price's upward momentum. In short, when the inverse head and shoulders plays out like this, it gives a strong reversal signal and lays a powerful foundation for prices to enter a long-term uptrend.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.